Hi guys, welcome back to the ratio part of financial modeling. And in the previous lecture, we looked at profitability ratios, and I thought of actually splitting the entire ratio analysis into small videos so that later on, when you have to refer for interviews, you can just quickly come to a video of 5 minutes and quickly get it revised. Okay, so let's today talk about in this lecture, let's just focus our attention to activity turnover ratios because I've seen a lot of questions coming in activity turnover ratios and can be confusing, right? But I'm going to give you a simple logic to all the activity ratios, right? When you are saying activity, you mean to say the daily operations of the business, right? Which means you know uh, building the product, buying the raw material, collecting the receivables, and managing your creditors. So that would sum up as the major activity. And then of course, how well are you using your assets? Well are you using your fixed assets? Could also be derived in activity, right? So let's get to the first logic of how this entire ratio is even built. Okay, so the ratio starts with trying to understand what part of the business do you want to analyze in terms of activity. So let's say we start from the fact that the problem of accruals which are there in my balance sheet and my income statement, right? Because the accrual system tells me that I can book the revenue when the good or the risk is transferred. So that means not all my sales which I'm doing, which is represented in my income statement, is actually cash. And hence the accrual account which creates created. So you've got sales happening in your income statement, right? And the part of it which is not cash, right? Not cash and will be received in the future, gets booked in the balance sheet as accounts receivables, and other names to it is also sundry debtors or debtors in general, right? So that means from a ratio analysis perspective, I would also want to know, I can't just blindly trust the accounts receivable, because there have been a lot of instances when companies are not able to actually collect the receivables back. I mean, they have receivables as long as 3 years. So you would want to know how quickly are you able to collect the receivables back, and if you're able to do it, try to get it in terms of days, it's even better. So now you need to understand that the accounts receivable turnover, when you want to understand receivables, obviously the linked account in the income statement is going to be sales, right? So we've got sales, right? And now we also have something called as receivables in my uh, you know balance sheet. So let me find out how many times is sales compared to my receivables. So then the what we could do is we could just divide sales, okay, upon receivables. So what we are trying to do is we're trying to find out how many times is sales compared to my receipts. Just a factor, okay? Just how many times are we are trying to find out, right? So let's say if the sales is was 100, okay, and the receivables was 20% for that particular year. So if I just divide 100 by 20, right? So then you get that sales is 5 times the receivables. That's all. So this is my sales turnover ratio, right? So this is just telling me how many times is it, nothing more. But it really doesn't give me any insight, right? So what now I can do is, can I convert this in terms of days so that I get a better insight, right? So in order to convert from the sales turnover ratio or the receivables turnover ratio to days, is to just take 365 as your working days, right? And you divide the turnover ratio whatever you calculated, right? So in essence, what you're trying to do is, first you try to find out how many times is sales compared to receivables. Now you're trying to find out if you were to proportionately calculate that for a year which has 365 days, and if you just divide 365 by the sales turnover ratio, then you should get days. So now you got 73 days as the time it requires on an average for the company to collect back its receivables. So that gives you a lot of insight, right? Which means it's not bad, right? It's not really bad. 73 days means probably about 3 odd months, 2.5, 3 months, right? And that means the working capital issue will not come. That means they will get the money, right? Because otherwise, if the receivables is too long, right? So for example, if you were to say that receivables is, let's say, 70 out here instead of 20, then look what happens, right? Your number of days of collection increases like crazy, right? So you have to be very careful, when you try to interpret the ratio, and don't try to mug up this, because it's just basic observation, right? Some intelligent guy just took sales and divided by receivables, trying to find out. So it's not an exact science, okay? It's just you're trying to reduce the size of the value, and you're trying to find out what kind of an effect it is. And just looking at days for 1 year is not going to give you any information, and just looking the days for a particular company only for a particular single company is also not going to make sense. You will have to compare it with similar companies, right? So if you in our case, we are doing Asian Paint, so we'll have to probably compare it with Berger. We might have to compare it with Nerolac, right? So that would give us that, okay, compared to the industry, we have better receivables. So the same logic, if you were to apply in, let's say, uh, talking about inventory, right? That's an interesting part. So if we talk about inventory, then we know that inventory, from our financial reporting mechanics class, we know that cost of goods sold in my income statement is related to the balance sheet value, which is called as inventory, right? And as and when the sale happens, that inventory from the balance sheet goes into my income statement, right? So this is how it happens. So a little bit of background I'm still giving. I hope that concept is clear, because if that the linkages are still not clear, I would suggest you go back to the FRM class. Okay, so IS, this is your balance sheet, okay, and you've got some inventory, let's say 500, right? Now this inventory will only become cost of goods sold when you sell it. Okay, so that means there's an associated revenue also. So let's say this inventory of 500, we took, let's say, 200 of it, and we are selling it, right? So that means your inventory would reduce by 200, right? So the next year's, so this is first year, this is second year, right? And in your income statement, what's going to happen is, since sold 200 worth of inventory, but you're not going to sell it at the cost price, right? So probably you will book your revenue, right, at double the price. So let's say 400, right? And this is your cost of goods. So now this 200 which you reduced it from here is going to turn up out here, right? So now what, in the ratio analysis, what you're trying to find out is how quick is this movement, right? Or is the inventory just lying down and we're not able to sell, right? So how efficiently are we using? So again, that means we are trying to find out what is the proportion of cost of goods sold versus my inventory. Now, if you go up and look up formulas in Google or any of the qualifications, they will talk about average, which is fine. That's absolutely your choice. Okay, when you're trying to average 2 years inventory, it's your choice. Okay, but I try to prefer to initially when I try to learn, try to do it for 1 year, so that you get the logic, and then you understand why you're doing average. Okay, so when you're saying average, is because you're trying to remove any a sudden rise or fall effect, right? That's all you're trying to do. You're just averaging it, right? And averaging is always trying to reduce the effects of one specific year phenomena, right? For example, if it was COVID, and if you were doing it for a specific year, so your inventory turnover would look very bad, right? So that's why you just take 2 years and it will give you a smoother effect, but nothing more than that. Okay, so cost of goods sold upon inventory is my ratio, right? So let's say in this case itself, my cost of goods sold is 200, right, and my inventory is 300, right? So this tells me that, okay, cost of goods sold is almost 66% of my inventory today. That's all that it's telling me, right? So that's fine. So that means, but still you're not able to really, I mean, I can interpret it even at inventory turnover ratio level. I can say that, okay, that's pretty good, because cost of that means you're selling almost 66% of your inventory this year. But you can also convert it into days to have a better insight. So again, the same structure, 365 divided by the inventory turnover ratio, right? So that means what you're trying to do is, what you're trying to say is that your inventory gets sold within 547 days, right? That's all you're saying. Now think about, if you were to sell more, what would happen, right? So if you were to say that you have sold, let's say 400, right? How much do we have left here? Yeah, so we can take 400. And now if you see that 400 will come up here, and now if you see the ratio itself, which is cost of goods sold, now will be 400. I'm so sorry, right? And now you see the ratio is better. That means you're selling quick. I mean, within 3 months the inventory is gone. So that is a healthy number to look at, right? In a similar manner, you can apply the same logic for how good are you managing your creditors, right? Creditors, remember, the same inventory that you bought in the balance sheet, right? 500. Not all you must have paid cash, right? So it must have also created some account in the balance sheet in the form of payables, right? So let's say I've tried to scribble a lot out here. Let me simplify this here so that we can take some numbers. So let's say balance sheet, and then we have our asset side, and we have our liability side. Okay, so there we are. Let me just get some basic borders so that I'm able to work with something. Yeah, so that's my balance sheet, let's say. Okay, and on this side we have, let's say, income statement. Okay, and now what we are saying is we want to talk about payables, right? So let's take it from the first section. So I'll make 2 years so that you understand the effect better. So this is the first year and this is the second year. Okay, and same goes for income statement 1 and income statement 2. So let's say initially we talked about, I'm going to take the same numbers. Okay, so let's say the sales is 500. Okay, and the cost of goods sold in this year is, let's say, 100. Okay, and that's what I'm just going to limit it to. And in this year, let's say sales is 600 and COGS is, let's say, 200, right? I'm just making things up, so don't take it very seriously. Now in the asset side, now let's say in the first year, when you actually got inventory, so inventory will not show up in the income statement, remember, because cost of goods sold, it will only appear when you are selling it. Okay, so let's say in the first year you bought some inventory. Okay, so I'm just going to write inventory out here, and I'm going to write payables out here. Okay, and on the asset side I will also have debtors. Okay, so there we are, and this is going to be my value. Okay, there you go. So let's say inventory bought about 1000. Okay, I'm going to make a big number. All right, and let's say the entire thing was bought in credit. Okay, so that means the entire second entry in my liability side will be the payables, right? There you go. Okay, and let's for a simplicity's sake, let's say that we consider income statement 2. Okay, because let's say that we didn't sell anything. Let's start from balance sheet 2. Now in the second year, what's going to happen? So we had inventory of 1000 out here, and we had payables of 1000 out here, right? Same structure. Now let's say we did a sale of 600. Okay, so we did a sale of 600. So that means I have taken some part of inventory and I've sold it, right? let's say that 600 comes up as debtors. I did not receive cash for that, right? But since you sold that good, uh, so let's say we sold almost 500 of this, right, to generate 600, or let's say let's take a simple number, let's say take 300. So we just sold it at double, so your inventory dropped by 300, okay, and that is what showed up as cost of goods sold in your income statement, okay. And the 1000 that we bought initially is still 1000, because you did not pay your payables still now, right? So 1000 is still the same. You have not repaid your creditors. Your inventory has just reduced by 700, and you can see that that's the balancing effect, right? And I'm not trying to do the liability side, so don't expect the balance sheet will tally for now, because I'll have to get the profit here, right? Now you see what is happening. If you were to look at this from a ratio analysis perspective, see what it will look like. So if you were to calculate three ratios, right? Let's say one would be inventory. So we will try to analyze inventory, analyze receivables, and we will analyze payables. Okay. Now you understand that inventory is obviously linked to the income statement cost of goods sold. So I'm going to take cost of goods sold, I'm going to divide it by inventory. So that gives me a ratio 0.42, right? So that means 42% of the inventory is what I'm selling in this given year. Receivables, sales divided by debtors. So how much of sales is, how many times is it compared to the receivables, right? So out here it is, what I've done is 600 divided by 600. So the entire thing is debtors, okay? There's no cash, all right? If this was slightly lower, let's say 500, then it would be a different ratio, okay? So just for simplicity's sake, I've taken that. And now payables is also related to finally your cost of goods sold, because cost of goods sold is what is coming from inventory, right? And your inventory is getting paid by some source, either that's cash or either that's creditors. So since we are talking about payables, we'll divide that by, let's say, the payables, right? So now we see that, okay, 300 divided by payables is payables turnover. Now if you were to convert, so this is the ratio, basic ratio, okay? And now let's calculate the days. So if you divide 365 by the ratio, now you get what is happening, right? So if you see receivables, since the entire money is getting collected, is debtors, that means it's going to take us one whole year to get the money, which is not good, right? Time value of money, right? Second is, if you see inventory, the ratio is 42%, which is cost of goods sold upon inventory, which says us that it takes us about 851 days to sell our entire inventory, which is true, because if you can see, we just have sold 300, right? If we were to sell, let's say 600, then my days of inventory would keep on reducing, right? So, and you have to obviously change out here also, right? So if you see, if you were selling fast, your days is improving. And payables, right? So let's go back to the previous scenario. Payables is cost of goods sold over payables, right? 1000. So it's saying that we pay our creditors, in 4 years, right? That's what it's looking like, because entire inventory was bought in credit. That's a good thing from a working capital point of view, that if you are having good credit terms, wherein probably you're beating your receivables. So if your receivables get collected within 3 months and your creditors can wait for 4 months, amazing. So that you will never require any working capital loan to run your business. So that's a basic idea of activity. I've taken almost 20 minutes to explain you this, okay? The reason why I did this is so that you understand the logic of the ratio rather than just blindly remembering the formula, okay? Now, the only complication is sometimes you might be given the days and you have to calculate the balance sheet value. So you've been given the days. So let's say we've been given 851 days, okay? and we want to calculate, let's say, inventory. So how can we do? It's just a reverse calculation, right? Remember how the formula is structured. So receivable turnover, or sorry, let's say talk about inventory turnover, okay, is what? Cost of goods sold over inventory, right? That's what it is. And then we go one step ahead and we say inventory days. What are the what is the formula for inventory days? So we just take the same ratio and we divide it over 365, right? So 365 divided by cost of goods sold over inventory, right? This is what we do, right? I'm just gonna put under, yeah, right? This is what we do. Now if you were to calculate inventory, now think of it, this formula, if you were to rearrange, it would look something like this: 365 divided by 1, and the inventory will go up, right? Because 365 divided by 1, so you will multiply this with inventory and divided by cost of goods sold, right? It's just flipping over. And on the left side you have days. Now if you were to calculate inventory, what would you do? You would say inventory is days. This cost of goods sold will go to the left, right? So multiplied by cost of goods sold. Okay, so cost of goods sold has got there, and it will, the 365 will come down, and what you will be left on the right side will only be inventory. So let's take our example itself. So we've got 851 multiplied by, hopefully the calculation doesn't go wrong because I have made some errors here, I have not updated it, but nevertheless let's try it out. So this is my days multiplied by cost of goods sold, and I will divide this by, divided by 365. There you go. So we should get the inventory, yes, and we got the inventory. So that's the reverse calculation for any ratio. You just need to rearrange the formula and you will be able to derive back the balance sheet value itself. So sometimes specifically in project finance, you might not get inventory value, but you might get the days value, right? Because let's say you're doing research on project finance and you were to make a road project, and you don't know what to take inventory, what to take debtors. So what you can do is you could go to the industry and see what are the days of inventory or the days of receivables, and then derive the inventory, and then also derive the working capital requirement, right? So that's a reverse calculation. So what you can do is, I'm not going to do it for Asian Paints. I thought that it's better to show you the logic, and the same thing you can do it out here. Probably in the next lecture, in the next video, I will show you the answers of this, and we can quickly have a small discussion on what it looks like for Asian Paints. And I'll see you on the next slide. Bye bye.